This is a lecture from Open Tuition.
In this series of lectures, I'm going to be going through the March 2020 Advanced Performance Management exam. I'm going to be concentrating on how I think it should be approached so that you accurately address the examiner's requirements and don't begin veering off to something else. How you pick up certain clues within the question about what might be particularly relevant to the companies featuring in the question paper. Because above all, what the examiner does not want you to do in this exam is to simply come out with, if you like, standard pieces of learning which you have not applied to the specifics of the companies or organizations featured in the paper. Before you go through any of these lectures, I strongly recommend that you download the question paper from the ACCA website and read through it, look at it, examine it. Probably best if you do this for question 1, then look at the lectures in question 1, question 2, lectures in question 2, and so on. If you don't do some pre-preparation, maybe thinking how you would have approached the paper, what you would have said, so that maybe you can later contrast that with perhaps something that is uncovered during the lecture. If you don't do that preparatory work, then I think you don't get full value from the lectures. So if you haven't downloaded this paper, I suggest you do that now. And then we'll commence with going through, in this particular video, question 1. And then there are 2 other videos for questions 2 and 3. Okay, starting at question 1. This is a 50-mark question. And before we even begin that, I would have hoped that maybe if you have downloaded the paper and had a look at it, you will have been struck by how few marks are going for calculations. The vast majority of marks are for example, writing reports, giving advice to people, rather than calculations. That's not saying that calculations are never important, but at this level, at this kind of advanced level, think of it as you have other people to do many of the calculations, and you are now dealing with those calculations, perhaps giving advice at a higher level based on what those calculations show. Anyway, what I always suggest is that you go to the requirements. So if we go to the requirements of question 1 and see what it says, here we are, I think, required. Write a report through the Chief Executive Officer. So we know immediately that we're going to be dealing here in some sort of report format, and there's going to be maybe a mark going for addressing the report properly with a title, to, from, date, and so on, having perhaps an introductory paragraph. To the Chief Executive Officer of Chile to respond to her instructions for work in the following areas. So it seems that there are somewhere else in the question a list of instructions that we must obey. And we are required to write this report on current performance reporting. Note, for goodness sake, this is not saying write a report on current performance. This is a recurring problem that the examiner finds. The examiner asks for you to appraise, for example, the performance reporting system, or the way it's laid out, for example, what it actually contains on it, and students go in and they start trying to comment on performance. That is not required on this. It is reporting, it is the system which is used by the company. Other proposed performance indicators. So again, it's giving us a clue maybe. These have been proposed somewhere, and maybe have to search for those. In other words, we're not making up our own alternative performance indicators. The changing role of the management accountant, that is perhaps a little bit of a question mark at the moment. And then opportunities and risks that can arise from introducing a new data warehouse. And that's probably something we would feel, that's rather a factual type of question. It has to be still tailored to the specifics of this company. But of everything that's here, perhaps the opportunities and risks arising from a new data warehouse may well be almost the easiest part of the question to address. Professional marks will be awarded for format, style, structure, and so on there. 4 of those. We have 2 appendices, one giving a strategic performance report, second one, appendix 2, other proposed performance indicators, and then there's some supplementary information. So this kind of forewarns us what the question is about. We know it is, 2 parts of it really, 23 marks plus maybe some of the style marks, are for performance reporting and performance indicators. And then the rest of the question, something perhaps slightly mysterious at the moment, changing role of the management accountant, and then perhaps hitting more of a comfort zone, the new data warehouse. So let's go through it. You will probably need to read it several times in the exam. But I'll go through it, and what I'll do is I will try to highlight as I go through areas which may have been easy to overlook, maybe obvious, but maybe easy to overlook, which we have to pay attention to if we're going to address the question properly. So, ACCA Retail, stock exchange listed business, and that may be relevant. It may be relevant when it comes, if, for example, you were looking at stakeholders, we know who might be interested in a listed company compared to an unlisted company. It may make available to us a share price, which is hard to find in an unlisted company. We don't know yet, but it's listed. Sells a range of clothes from a website to consumers. So a range of clothes, does the nature of the business tell us anything? And perhaps the idea of a range of clothes here might give us some thoughts maybe that there might be a kind of inventory, type of problems. Clothing fashions change quickly. They could be having difficulties sourcing saleable inventory, knowing how much to order. We don't know yet, but we're just kind of bearing in mind a high fashion business is rather different to a heavy engineering company. The company started its chain of clothing shops, but has slowly transitioned to website, only business, and it sold its last physical shop recently. So this here might be a relatively kind of new type venture, or new way of doing business, which again may be relevant. And then a very, very important paragraph. ACCA's mission is to deliver long-term returns to stakeholders through a combination of sustainable growth in earnings per share and the payment of cash dividends. The mission is important because if, as we know, this is to do with performance measurement, performance indicators, we have to know what is meant by good performance. And here it is saying that good performance is judged by this long-term sustainable growth in earnings per share and the payment of cash dividends. We're saying at the end of the day, this is what matters, and this is ultimately where performance indicators have to be kind of focused. However, the company has recognized I suppose that good growth in earnings, good growth in cash dividends are the measures of good performance. Neither of those tell us how good performance is achieved. How come we get good profits? And by and large, the reason you get good profits is you make goods that customers want at reasonable prices and that you stay ahead of the game. And the company has at least recognized here some subsidiary objectives: improving product ranges, increasing the number of customers and their individual spend, focusing on customer service, and improving profitability by efficient cost control in purchasing and inventory management. So if the company has recognized that growth in earnings is required, payment of cash dividends is required, improved product ranges are necessary, increasing number of customers and their individual spend is necessary, focusing on customer service is necessary, improving profitability by cost efficiency and so on is necessary, then really we need performance indicators which address all of these. Okay. One little area we have to be, I'll kind of highlight now, although you may not have, something you pick up in the first reading here. It does not say more product ranges, it says improving product ranges. A company could easily double the numbers of types of products it sells, but if it hardly sold like 50% of those, it could say, well, I've increased product ranges, but that's not improving product ranges. A product range or an item in the product range is only worthwhile if it actually makes decent sales and decent profits. We need to contrast that maybe with increasing the number of customers. But it's not just any old customer who spends $5 and then is never seen again. We want to increase their individual spend, and that's important to focus on. Focusing on customer service. It doesn't give us much clue here what's meant by that, but we could always be thinking, if we had to, it probably means decent turnaround time, it probably means no errors in the goods dispatched. It almost certainly means good quality goods. It means a pleasant visit to the new website and so on. It might mean that if somebody's having difficulty with an order, they can ring up and actually get to speak to someone rather than being kind of rung off at the end of some complicated menu system on the phone. Improving profitability by efficient cost control in purchasing and inventory management. So profits are the difference between the sales or revenues and the costs, and at least they have recognized that the feeding into increased profitability is cost control. The second rather hidden element within this, which is very, I think, easy to miss, is sustainable. The company hasn't simply said we want growth in earnings, we want growth in payment of cash dividends. It wants sustainable. In other words, if we were not just looking at what's happened in the past, but we'd look maybe 5, maybe even 10 years ahead, though that's difficult, of course, but certainly in the foreseeable future, let's call it 5 years, we want to see a way in which it is likely that profits and dividends will be increasing. And we need, and if this is important, we need again to keep an eye on some measure or indication of sustainability. Otherwise, that important quality will simply be omitted from the performance reports and performance measures. Going on, the board feels that while performance has been good compared to other retailers in general, it is lagging behind the growth of online retail clothing sector. And how do they know? Well, is this implying that maybe a benchmark is needed? A benchmark. How do they know they're lagging behind? And if they are lagging behind, they will need to investigate why. Is it that the prices are too high? Is it that the goods are simply unfashionable? Is it that the delivery time is too slow? Why is it lagging behind other people, and by how much? We can't sit in a vacuum and really decide on performance measures. They do imply, ideally, some sort of external comparison with your competitors. It is felt that many of the systems and processes have yet to adjust to the new reality of a web-only business. So there may be a little kind of problem here with the web page. Just put in a web page. One of the experiences of customers is focusing customer service, if you like, is maybe how slickly and efficiently and easily their experience of the company's web page goes. And it may be important, particularly in the early days where they're still developing and maybe experimenting with their new website, it may be important that we spend some time trying to assess how successful that is. The CEO has been reviewing the business in order to identify areas of improvement, and she's focused on the current performance reporting and the more effective use of data which the company has. Current performance reporting. There was a debate as to whether performance towards the mission and its subsidiary objectives are usefully measured. A director raises the concern and believes that any fault might lie in the board's performance report for the annual strategic review, although the CEO is thoroughly happy with that report. Therefore, the CEO wants a full evaluation of the current performance report. Now, essentially, I think that is relating back to requirement 1. And it says evaluation. Evaluation is not the same quite as criticism. With evaluation, you expect pros and cons. There may be good things to say about this report, as well as criticisms to raise about it. In the light of this debate, and also more generally in terms of best practice for reporting performance. So we have to think what might be under the heading of best practice for reporting performance. So we say maybe the report doesn't do that, but best practice in reporting performance would suggest that it did do that. Note that it says no need to suggest new indicators. Now, I think well, almost certainly you'll find that quite difficult, because if you are criticizing the current content of the report, it is a very difficult job not to say this will be greatly improved if they just split this figure over different departments or something of that sort. And probably you will write it, but don't, for goodness sake, make a big issue of small suggestions, and certainly don't seek them. Other proposed performance indicators. At this board meeting, and as a result of the disagreement, a number of new performance indicators were discussed. The CEO wants an assessment of these indicators, including their calculation, and calculation if that is possible from the data which is supplied, and also how they link to the mission and subsidiary objectives, if indeed they do. So this is where in Appendix 2, I think they were talking here about the proposed performance indicators: return on capital employed, total shareholder return, inventory days, receivable days. These are additional performance indicators, and we have to judge basically whether they're going to be of any use to the company in achieving its mission and thereby, fundamental to that, achieving its subsidiary objectives. Role of the management accountant. This was our mystery topic here, really. The CEO recently introduced a new enterprise resource planning system. And usefully, the question says the system will provide a single database operating across the whole organization to replace systems which had been built up in each function around their basic website. The functions, for example, purchasing, warehousing, fulfillment and sales and marketing, will all now work on a common technology platform. The plan is to move decision-making to individual managers. In other words, essentially a devolution of power, a delegation of power down to individual managers. And these are managers of cross-functional teams. Cross-functional, are we kind of thinking here of matrix maybe? Is that a word that might come up? Are we thinking of going from a tall, narrow structure, maybe more to a wide, flat kind of management structure? That's what tends to happen when you are delegating responsibility down. You need, in a way, fewer mid-managers, because what are they going to decide on if the decisions have been delegated down to staff? So cross-functional teams will work on all aspects of the given selection of product lines, such as women's or sports clothing. For example, purchasing will now liaise more closely with sales and marketing in order to ensure that the best possible and most profitable product range is available. In other words, it's basically tying stuff together. If they see sales of, let's say, certain sports clothing is going up, they need to make sure that they can respond quickly by either buying it in or making it when it was happening here, distributing it to all the different warehouses, if indeed they have more than one warehouse here, but certainly making sure that they're not going to run out of stock on the website. Thereby, it is hoped, I was in front of myself there, it is hoped they will reduce the number of senior managers, so flatten the organization's hierarchy. The CEO has been reading about the works of Burns and Scapins. Here's where your heart either leaps for joy or you think you're walking out of the exam. Because there is a very specific area of the syllabus which is being addressed here, and if you don't know what Burns and Scapins suggested, and as it says further on here, it talks about here 3 drivers of change identified by Burns and Scapins. If you don't know those, you can't make them up in the exam, and I think it's about 11 marks gone or something from that. So this exam is not all about, kind of solo flight on the day, making it up as you go along. There are very specific bodies of knowledge on which you can be tested. Data warehouse. In order to catch up with the rest of the online retail sector, CEO believes that the key step will be to effectively use a vast amount of customer data which the website collects. So every time basically you go to the website, it can track what pages you went to. It obviously knows what you've bought and so on. Vast amounts of information available there. In a further step forward, in the use of information technology, she intends to create this data warehouse and use information to help achieve the objectives. It collects data from customer activities and also from social media. Goodness me, it costs 50 million. And she wants an assessment of the opportunities and risks which such an expensive system would present. Note, it does not want a description of a data warehouse. It does not want a description of big data. There may be elements of the 4 V's which are relevant, but you don't want to start out this question by saying this data warehouse will have volume, variety, velocity, hopefully veracity and so on. That's not at all what it wants. It wants you to address the potential opportunities and risks which this very expensive system might give rise to. So basically that's the 4 parts of it there. So let's just think very, very quickly about the current performance reporting. we'll really talk, I think, about the first two. I have written an answer to the three questions in this, and you can compare my answer to the ACCA answers and so on. But I'm not going to develop a whole answer for all of these in huge detail. But let's look at the current performance reporting. And remember what we want to do. We're not criticizing or assessing performance. We are looking at the performance reporting. And we can only judge that with reference to the mission and the subsidiary objectives which the company has. So we want increasing profits, we want increasing dividends, we want good customer service, we wanted cost efficiency, we wanted improved product range, and we want increased customer numbers where each person's average spend increased. And it's really how far, to what extent does the report address that, but also there's this best reporting practice, which can be things like layout. Is it cluttered? Is it plain? Is there any way perhaps in which it could be relatively easily improved a little bit? So let's look at this. What do we see? Well, 2 years here, 2x5 and 2x4. And the first thing that maybe strikes me is that although we have got the revenues and the gross profits broken down for 2x5 across the 4 different ranges of products, women, men, children, sports, we don't have it broken down across 4 in 2x4. And I would have thought that it would have been quite important to be able to compare sector to sector here. Because the chances are that some of the product areas might be doing well, some others might be doing badly, and we need to know what's what. I'm not quite sure where I'll bring this in. This might be best reporting practice, that it simply doesn't give the detail that we require to be able to do very much, to draw very many conclusions, really. But it seemed to me to be a very easy and obvious step to break down the 2x4 sales and gross profit, to see where we're doing well, see where we're doing not so well. It goes down and shows the earnings per share and the dividends per share here. Gosh, and they haven't changed. So this business of wanting to show increasing earnings and increasing dividends, so I've got the wrong ones there, and increasing dividends, and the operating profit hasn't changed either, they're not really meeting the mission. Nor, if we go back to it, is it saying anything about sustainability. It might be interesting to see the year before, to see if we can see a bit of a pattern going on here, even 2 years before. I think it would certainly be worthwhile, given their concern about sustainability, to maybe see into the future, to see what they're thinking about 2x3, or 2x6, 2x7. And particularly, it'd be interesting to see the future for all of these, because some of these go through phases. I suppose how keen people are on certain sports goes up and down. How keen people are on certain fashions goes up and down. To some extent, according to the economic prosperity of the country, is a big driver in fashion. And it could be that children's clothing is staying fairly buoyant in the future, whereas maybe men's clothing seems to be tailing off in the future because maybe men have become or will become in the future less interested in keeping up with high fashion. But we just don't know with this report. So some nod towards sustainability would be interesting. The question also talks about efficiency. It talks about efficiency, I think, in cost control and inventory management. Let me just look up at what it said here. Oh, yes. Was it down here? Receivable. Oh no, it was a subsidiary. What's it up here? Yes, it wanted improving profitability by efficient cost control in purchasing and inventory management. We look to see, does it address that very much? Well, what do we have about inventory in here? Nothing really about inventory costs in there that I can see. Nothing very much in there about scrapping goods, because undoubtedly in a fashion business they will have had to write some goods down because they made the wrong guess at what would be fashionable. Nothing there about that. There's nothing on the report, say, about days of inventory, because usually if you're dealing with efficiency in inventory, the number of days of inventory is something worth looking at. It talks about staff costs, it talks about marketing, it talks about other operating costs, and that's okay. But again, it might be nice if they can, but it may be very difficult, to divide that across some of these sectors, so that we can get almost a profitability per sector rather than just a gross profit per sector. I think that would be, again, probably coming into best practice. It's somewhere maybe where we could say, well, they're not really maybe providing information in quite enough detail to allow people to draw reasonable conclusions. What about the subsidiary requirements here? And one of the subsidiary requirements was to improve the product range. And if we look down here, number of product lines sold here, it's gone down. On the face of it looks bad, but what they might have done is got rid of 3 product ranges that weren't selling. But simply looking at the number of products sold is inadequate against the requirement to improve product ranges. It means having more of the products that sell well, having less of the products that sell poorly. Is not just an exercise in total numbers. We're not asked to suggest other measures here. If we had been asked to suggest other measures which we have to stay away from, then of course some feedback from customers might be quite interesting on what they think of the product ranges and their fashionability. What else came into the subsidiary objectives? And we had an increasing number of customers and their individual spend. What do we have down here? We have the number of customers' accounts. Okay, we can see that's increasing. We are looking at how active they are, and that's quite useful because, again, really we could always quibble with wanting to increase the number of customer accounts because some of these could be dormant. And it gives the average spend per customer purchase, which is not what they want. They wanted the average spend per customer. To some extent, average spend per customer purchase tells us very little about individual customers. This is taking all purchases, total sales, and divided by the total number of purchase incidents, if you like, and saying, on average, each purchasing occasion was worth $20. And this is a kind of average which applies to the big spenders and little spenders. They want to know average spend per customer. So we can try to work it out. We can, from that, get some idea of who the key customers are and who the bad ones are. What about the commentary? We'll come back to the other performance measures in a minute. Overall performance is satisfactory, they say. Well, that's a load of rubbish. I'm not quite sure how it is satisfactory if profits haven't increased, earnings haven't increased, and dividends haven't increased. That seems to be, if you like, best practice. That seems to be not looking at information you have in a subjective way. It's really quite a poor set of results. Revenue is up 10.4% the previous year. That's okay, but revenue isn't the most important thing here. They said the number of customers and average spend per purchase increased, but again, we know that's not what they want here. And presumably feeding into customer service, we have deliveries to customers continue to be made within the promised deadline. So the deliveries to customers in here, deliveries to promised deadline, it's staying at 97. Is 97 good or bad? I don't know. And again, we could come back to the best practice and say, just looking at 97, seeing that 97 was a figure last year and this year, we don't want to become too self-satisfied with that. We don't want to become smug. If your competitors are all hitting 99.5%, 97 is actually really rather bad. What else do we have in here? We have got a subsidiary objectives. Focusing on customer service. Okay, we just got the one thing which focuses on customer service. That's perhaps a little bit inadequate. Efficient cost control and purchasing. Well, again, it's a little bit thin on that. It says very little about the purchasing efficiency. It says very little about the purchasing control and so on. Perhaps it lumps too much together. Not really enough detail for the board to know if these subsidiary performance measures are all being met, and therefore the likelihood, if you like, of them causing profitability and the dividends to be increasing. Second thing we were asked to look at was to look at the other proposed performance indicators, exactly what we wanted, an assessment of these indicators, whether and how they link to the subsidiary objectives. That's what's required here. So to look at these, I think it's 4 other proposed performance indicators. We want to assess them. How good are they? Can we calculate them? And do they link at all to the mission and subsidiary objectives? So let's look at what was proposed here. Return on capital employed. Now, return on capital employed is not mentioned anywhere in the mission. The mission talks about, I think, improving earnings, I think it says. Or is it improving profitability? You have to keep kind of flicking back here. Combination of sustainable growth in earnings per share and payment of cash dividends. Strictly speaking, the return on capital employed, you could argue, is not mentioned in the mission, but it would be perhaps a peculiar business if it didn't report on return on capital employed, because anyway, anyone can increase profits. You just double the size of the business by raising the same amount of capital again. But maybe what's important to shareholders is the profitability of the company compared to the amount of capital which is invested. So I think we could say it might be worthwhile, but I think you'd have to argue for it, if you like, and say, yes, the mission of improving earnings, improving profitability does depend on getting a decent return on capital employed. And I think we can calculate that, because we can calculate the gross profit or operating profit, and we can calculate from this little balance sheet, we can calculate the capital employed, so we can calculate the return on capital employed okay. Total shareholder return is an interesting one. Total shareholding return looks at both capital gains and dividends. So it looks at how the share price has increased over a period, plus the dividends over the period. This is in total how much richer the shareholder is over the period. And that, if you, again, could be quite useful for shareholders to know. The dividends might not have increased, but if the share price has increased, to what extent does that difference matter to the shareholder? Again, it's not in the mission statement, not in any of the objectives, but increasing total shareholder return might be something which I would find useful. Inventory days, because remember the question says, let's just go back and check we're answering that right, because I think you need to do this as well a little bit. What did she actually ask about this? She wants an assessment of these indicators, including their calculation, and also whether they link to the mission and subsidiary objectives. So this assessment is possible. So I think we could perfectly validly say, is the return on investment something worth pursuing as a measure? Is the total shareholder return something which they consider putting in? Is it a potential worthwhile thing to set up as one of the major objectives of the company? It might not feed into the existing mission directly, but maybe we need to change that a little bit. Inventory days, I think we would probably calculate that because we know the purchases, we know how much inventory there is. Inventory days would help us to judge maybe the efficiency in purchasing. I think when you calculate this, it goes down a little bit. On first glance, that looks good, but I think it's worthwhile saying that you can easily lower inventory days, but the trick is not also to lower customer service, because as you lower inventory days, the chances are that you've got more stockouts, people have to wait longer on those goods and so on. But like many of these things, you can't just concentrate on one performance measure. You have to keep a number of balls in the air at once. Receivables days is a very common measurement to make the number of days credit that customers take. Here it is essentially useless because this is a web trading company, and when you go on the web and buy something, you give your debit or credit card number, and it is not up to you when to pay. The money goes out of your account into the bank, and then usually after 3 days or something, it automatically goes from the bank to the seller. And the seller has got very little control, and the management of the company has got very little control over how quickly that money arrives. The good thing is it's not likely to be very long. So it's not likely to be 60 days before you get your money. It's likely to be 3, 4, 5 days before the bank passes on the credit card amounts to you. So it's not really a bit of a red herring because the company is trading on the internet. So that's requirement 1 and requirement 2. The existing performance reporting, proposed performance reporting indicators. Now, the changing role of the management accountant, Burns and Scarpins. We have to get marks. We have to know what these people were talking about. Now, it's in the answer, but broadly, Burns and Scarpins was saying, in the olden days, management accountants sat in a little office, prepared budgets and variance reports, and these budgets and variance analysis reports would be sent to various managers, would be looked at by the board, who would then ask questions. The old management accountant type of job description was therefore very passive. Burns and Scappens said, we will allow the management accountant out of his small office in the corner, and the management accountant will now be much more involved, a much more active role in helping other management areas know what information is relevant, collect that information, display that information, and help people to make decisions based on that information. So, for example, in sales, the sales department will be very interested in knowing, what goods sell well. That's a very easy thing for them to say, but it may take a management accountant's input to say, well, it may be selling a big volume, but it makes very little profit because the costs are so high. Or if you look at the kind of historical trend of this, it was going up, very popular product, but now this report I've prepared shows it is going down. And maybe it's had its day. Maybe we want to think of withdrawing that product. They can make similar inputs to maybe deciding, should we open in a particular country, or maybe close down operations in a particular country, because although it's maybe making a small profit, by the time we think of all the and cost up all the kind of trouble and bother it's costing us to maintain an operation in that country, maybe that kind of opportunity cost could be better invested somewhere else. It's not that necessarily management accountants will be, taking over the roles of the sales director or the purchasing director or the production manager or something like that, but they will be working much more in close liaison with them. And this ties in very well with this delayering, flattening of the organization and the delegation of power downwards to managers. These managers and the ERPS will provide them with much more information. They can pull out all sorts of information, and it may be the management accountant who knows what information is there, what it might be useful retrieving, how to display it in some meaningful way, that the functional manager can make some sort of decisions. The three particular areas that Burns and Scarpins, three particular drivers that they were talking about, was technology, changes in technology, changes in the management structure which takes place, and competition. In particular, changes in technology means that there's more easily available, flexible information available to everyone. And if you have this kind of multitude of information, maybe it takes the management accountant's skills to allow functional managers to see the woods for the trees, to see precisely what sort of useful, ultimately profit-related information can be extracted from the ERPS. Secondly, as we've kind of mentioned a little bit already, there is the management structure. We have a flattening. We have a kind of matrix structure. We have people working in cross-functional teams. So you might have a team looking after women's clothing. So there you would have a person in charge of sales and marketing, one in charge of purchasing or purchasing, let's say, one in charge of maybe the website design for that particular part of it, and maybe you have assigned to that a management accountant who would help the team involved in women's fashion to make sense of what they're seeing in the figures. So particularly as you delayer, and these people are in many ways perhaps younger, less experienced, perhaps they need more help from people like management accountants when it comes to making sense of management accounting information. And finally, we have competition. Competition, it's safe to say, in nearly all sectors, but particularly in the fashion business, particularly in businesses trading over the internet, competition has become fiercer. The internet allows people to visit lots of different sites, and there's great transparency in prices, great transparency in warranty terms, great transparency, perhaps in the quality which is being offered, because of course very often customers are allowed to comment on whether they think a particular product is good or bad. Competition will be fiercer. And if competition is fiercer, it becomes more important than ever to know which products are of key importance, which customers are of key importance, perhaps which market sectors are of key importance. Because if you sleep on this, if you kind of blink, then some competitor will come racing in with a special offer, new products, new offers, whatever it is, and they're going to start stealing your market share. So the fierceness of competition means that everyone has to be, up at their best game, on their toes. And this requires lots of useful advice coming from the accounting side of the business being transferred to other functional departments. And finally, we have the data warehouse here. The data warehouse costs 50 million, and the CEO wants the idea, the opportunities and risks of introducing the data warehouse. First of all, potential opportunities. You will know much more about customer activities. You know what web pages they buy, they visit. You'll be able to analyze maybe somebody who's so close to buying a product but changed their mind, begin to wonder why that is. You will get not only to know more about what products are popular, but what specific customers like. And if, say, a customer has bought, let's say, 1 year a football shirt, then the next year when the new football shirt is issued, then if you write an email to that person saying, oh, by the way, this new Manchester United shirt is issued, you can make the suggestion that maybe they'd like to buy it and so on. So there's more information about products, more information about customers, more information about different areas of the country. You maybe get feedback through it if you allow people to comment on goods and so on. You might be able to look at keywords in some of the social media to see which words or comments are particularly trending and the like. We'll be able to keep more historical records. We'll see trend in sales, maybe seasonal trends and so on. There are an awful lot of opportunities that come from keeping a data warehouse, historical information on the sales of products, the customers who buy them, when they buy them, the particular sectors of your customers who buy particular goods. Risks. Well, 50 million is a risk. Secondly, will it work? You can spend 50 million, get very little from your business, but having spent 50 million, we want to in some way have some sort of assessment that 50 million will be at least balanced by increased profitability. The technical feasibility might be up for grabs in terms of getting information from social media. How accurate is that going to be? How accurate will information in general be? Because if you have inaccurate information in this data warehouse, you'll be using inaccurate information as a basis for decisions, and almost certainly your decisions are going to be wrong. And then, of course, there's the big horror story of data warehouses, that the information escapes, that personal information gets hacked, and the company may be subject to fines, and it may be subject to reputational damage. And we know, even some very large, skilled online companies have suffered very, very serious data breaches, for which they've had severe penalties to pay, and their customers were not at all happy. So I suggest that what you do now is you can read both the ACCA answer and you can read my answer to this. I hope that by kind of going through the question with a bit of a fine-tooth comb, making sure that we address the requirements. We're talking about performance reporting, not performance. We had to pick up the idea of sustainability. We had to pick up the idea of the average spend per customer, not the average spend of all customer orders and the like. We had to find maybe some good things and bad things about the report. I mean, the report is easy to assimilate and so on. That's a good thing. Plenty of bad things in there as well. Hopefully by going through the requirements information in some detail will help you to see how you have to work hard with the question, really wrestle with it to make sure that you extract maximum marks from it.